71%. That's how much of the world's reserve currency was held in US dollars in the year 2000. It was untouchable, unquestioned. The dollar wasn't just winning, it was the only game in town. Today, that number is below 58%, and it has been falling every single year. Not because of a crash, not because of a war, not because of any single dramatic event you saw on the news. It has been falling quietly, methodically, and mathematically while most investors weren't paying attention. Here's what that number actually means for your wealth. The dollar dominance isn't just a geopolitical talking point. It is the foundation underneath American asset prices, American borrowing costs, and American financial power. And for the first time since World War II, that foundation has real cracks in it. Not theoretical ones, operational ones. So if you have serious money, real estate, a business, retirement assets, what's about to happen in global currency markets is not abstract. It reprices everything you own. To understand why this matters right now, you need to understand what reserve currency status actually does for the United States. Because on the surface, it sounds like a boring institutional concept. But in reality, it is the greatest financial cheat code in human history. Here's how it works. Every country on Earth needs dollars to buy oil, settle international trade, and pay cross-border debts. Which means every country is permanently in the business of buying US bonds and holding dollars in reserve. The result? America gets to borrow money at the cheapest rates on the planet. Economists estimate the US saves over $200 billion every single year just from this arrangement. Nobody voted for this. Nobody signed a treaty. It fell into place after World War II when America was the last major economy still standing. And for 80 years, the world has operated as if this arrangement is permanent, like gravity, like taxes. It is not permanent. And 2026 is the year the math stopped being deniable. The decline didn't start last year. It started after 2008. When the Federal Reserve began its quantitative easing programs, central banks around the world started asking a question they had never seriously asked before: are we too concentrated in dollar-denominated assets? Then in 2014, the US imposed sanctions on Russia. And now the question changed entirely. It was no longer about concentration risk. It was about something far more dangerous: what happens if Washington decides we can't use dollars at all. And then 2022 happened. The US and its allies froze roughly $300 billion in Russian sovereign assets and cut Russia off from SWIFT, the messaging network that runs essentially all international banking. Whether that was the right geopolitical call is a different conversation, but the signal it sent to every central bank on Earth was unmistakable. The signal was this: the financial system you depend on can be switched off at any moment if you go against Washington. And from that moment forward, central banks stopped just holding dollars out of habit. They started looking for backup plans. This is where it stops being politics and starts being engineering. Because you can't replace the dollar with a speech or a summit. You need infrastructure. And quietly, in 2024 and 2025, that infrastructure started going live. The first piece is called mBridge. You've almost certainly never heard traditional financial media cover it. It's a blockchain-based cross-border payment platform, and it's designed to let countries trade directly with each other with no correspondent banks. No JP Morgan, no New York, and no American visibility into the transaction. For decades, a trade between Brazil and China still had to route through New York, through US-regulated infrastructure, through American banks. mBridge is designed to make that unnecessary. The second piece is something called the unit. In January 2026, it moved from concept to operational pilot. It's a blockchain-based settlement tool for BRICS countries backed 40% by physical gold and 60% by a basket of member currencies. In plain English, it's designed to price commodities without using the dollar as the reference point. And that matters enormously, because one of the dollar's deepest, least visible forms of power isn't just that oil gets paid for in dollars. It's that oil gets priced in dollars. As long as every commodity on Earth is quoted in dollars, the dollar is embedded in every global transaction. The unit is a direct attack on that system, and it's not just infrastructure. The behavioral data is shifting too, and it's shifting fast. Since 2022, central banks have been buying gold at the fastest pace in modern history. Brazil and China signed a bilateral trade agreement settling transactions in yuan and reals, cutting the dollar out entirely. India completed its first purchase of UAE crude oil using Indian rupees. And Saudi Arabia, the cornerstone of the petrodollar system for 50 years, has openly discussed accepting Chinese yuan for oil sales. Now, here's the critical nuance that separates sophisticated thinking from headline thinking. None of these things individually replaces the dollar. Not BRICS, not mBridge, not gold buying, not bilateral trade deals. The dollar is still dominant. The US financial system is still the deepest and most liquid in the world. But that's not the point. The point is optionality. For 80 years, countries held dollars not because they loved the dollar. They held dollars because there was nothing else. No other liquid market, no other settlement system, no other option. And optionality is what kills monopolies, not competition optionality. The moment a viable alternative exists, the monopoly premium disappears. Slowly at first, then all at once. I want you to think about something for a moment, not as an investor, as a builder. Every serious net worth you've accumulated, whether it's through a business you built, real estate you bought, equities you held through downturns, was built inside a specific set of rules. Rules where the dollar was the measuring stick, where US treasuries were the risk-free baseline, where American financial infrastructure was the default for global commerce. Those rules are not being thrown out tomorrow, but they are being renegotiated. And the investors I respect most, the ones who built real, durable wealth across multiple decades and multiple cycles, they all share one trait. They never confused the rules of the current game with the permanent rules of the universe. They understood that the conditions that created their wealth are not automatically the conditions they'll compound it in. The dollar's decline isn't a crisis for people who see it clearly. It's a repricing event. And repricing events are where generational wealth either gets protected or gets permanently impaired. The difference is almost always whether someone understood what was happening before the headline told them. Here's what I want you to sit with. The US dollar losing reserve currency status is not a conspiracy theory. It is a measurable, documented mathematical trend that has been moving in one direction for 25 years. The infrastructure to accelerate that trend went operational in 2026. The geopolitical motivation to use that infrastructure has never been stronger. And most American investors, even sophisticated ones, have portfolios built entirely on the assumption that the dollar's dominance is a fixed constant. It isn't. And the question worth asking yourself right now is not whether this is happening. The data has already answered that. The question is what your portfolio looks like if the dollar's share of global reserves drops from 58% to 45% over the next decade. What does that do to your bond holdings, your real estate values, your dollar-denominated cash positions, your exit multiples on a business sale? These aren't hypothetical questions. They're the questions that separate reactive investors from deliberate ones. If you want to keep tracking the structural shifts that are actually moving markets, the ones that don't get covered because they don't generate clicks, this channel is built for exactly that. Subscribe, turn on notifications, and drop a comment telling me what you want me to cover next, because the best conversations on this channel happen in the comments. The era of US financial dominance isn't ending in a crash, it's ending in a trend. And trends are only invisible until they aren't.